Good afternoon, everyone. Welcome to the Krasny Financial Webinar on how to handle market volatility. My name is Rob Adams, Client Relationship Manager at Krasny Financial, and with me today we have our Chief Investment Officer, Steve Tuttle. And we felt that, with recent volatility in the markets, that it would be a good time to have sort of a special webinar on how to handle market volatility and how we handle market volatility. Last week, Thursday, June 23rd, the Dow Jones average was at 18,000, and in just 2 days, it dropped to 17,140, a 5% decline. And then just 3 days later, here we are, back to roughly 17,800 or 900, and we're only down 0.7% from the high that we had hit last Thursday. So that's quite a bit of market volatility we've had in a very short period of time. So what I want to do is hand the call over to Steve Tuttle, our Chief Investment Officer, who's going to go through a presentation on market volatility. And at the end of the call, we did have a couple questions that were emailed in by our clients, and so we'll go through those real quickly. And Steve, why don't you take it away?
Thank you, Rob, and thank you everyone for joining us today on the call. I'll start with a definition of how I view market volatility. I think market volatility is the cost or the price for seeking return. I think it's in fact of every investor's lives, and it's something that we all have to deal with. The fact of the matter is financial markets have moved dramatically up and down for as long as stocks and bonds have existed. And we're all human. When stock prices fall, it's quite normal to worry. I'm sure you worry. I know I worry. That's part of my job, actually, Chief Worrying Officer. But it's a fact of investors, and it's a function of trying to seek return. Part of this presentation will be to see and to discuss different ways that we look at risk and volatility, and a lot of it comes down to trying to help clients withstand the impact of volatility. And really it all starts with if you're overly consumed and too worried about short-term losses, quite honestly, you probably shouldn't own stocks. And that might not be what you hear from the media. Stocks are good, stocks go up, but along with that is the risk and volatility side. So the reason we all want to own stocks is from this chart right here. Right? So this shows the blue and the gray U.S. stocks over the very long haul. That's a very steep rising line. Investors who are able to invest in stocks and hold those stocks through good times and bad have historically done very well. So that's the goal. That's what we all want. That's why we invest. The problem is we're humans, and study after study has shown that average investors aren't able to capture all those returns. A lot of it has to do with volatility. Volatility can bring out our worst instincts and cause us to make poor decisions at exactly the worst times. So this is one of the studies that shows the returns of just about every asset class you can think of compared to what the average investor returns are. And as you can see, the average investor doesn't fare very well. So the challenge to us is how do we move from all the way on the right side here more towards the left side? How can we capture a higher proportion of those returns from stocks, bonds, and other asset classes? Some of it comes down to avoiding mistakes. Some of it comes down to having some discipline. Some of it comes down to having a good partner to work with you to stay on course. And this is ultimately what drives a lot of our decisions. We're all human. Humans, well documented in research, humans are not wired for disciplined investing. when people follow their natural instincts, and a lot of investors do that, they tend to apply faulty reasoning, all right? It's very critical to have a process to offset these mental errors that we're all subject to. And here's another slide that I think we can all relate to. I do, having about an hour commute in the car to work every morning, I can relate to this quite a bit. So we've all been in the highway and traffic is kind of slow and we're in the right lane and it looks like the left lane's moving a little faster, so we move over to the left lane, and then all of a sudden it looks like the right lane is moving faster, so we move back over to the right lane. You try to anticipate, you try to guess, you try to outthink things, and usually it doesn't result in any better outcomes for you. It just adds to frustration and anxiety. And I think in many ways that is a similar way we all feel about investing. One of the classic mistakes that investors make is that they go through a period of time where perhaps their returns are not as high as someone else's are. They hear from a neighbor or a friend or on TV that there's other strategies that are doing better. And then after those strategies have done better, they decide to switch course. And invariably what happens when you do that, when you chase returns like that, it doesn't always work out in your favor. So I think the key is to maintain perspective. And I'm going to talk a little bit more specifically about risk, different ways to minimize those effects and to stay on course. So when markets go through volatility, it's quite normal to fixate on those losses and to wonder, should I sell? Is now the time to sell? Am I invested in the right strategy? Scientists call this recency bias. It's the tendency to overweight recent experiences and to project them into the future for long periods of time. All right, stock market has been kind of flat the last several years. Is this going to continue for the next 10 years? And if so, well, why am I invested in stocks? Well, the fact of the matter is stocks probably aren't going to stay where they are for the next 10 years. And that trend that we saw in that slide a few minutes ago, where stocks do generate returns, is likely to resume at some point. So over the long term, weathering the short-term declines can help your portfolios grow, and having a good advisor to look past today's concerns, today's uncertainty, and certainly we have a lot of concerns and uncertainty outstanding today. But if you can look past that, I think we all would have a much better chance of achieving long-term growth potential of the markets. So let's talk real briefly about risk. Risk is neither good nor bad. Risk is a required and essential part of investing. Without risk, there would be no return. So the key to investing, I think, is not necessarily focusing overly on the return. The return is, as we all know, if you've invested for a while, the return, particularly in the short term, is an outcome that we have very little control over. We have more control over risk. There's certain things that we can do to manage that risk, and that's where I think it's prudent to spend more time and effort managing the risk and balancing that risk against expected returns that we hope to achieve in the future. So I talked in general about risk, and I've been pretty much talking about these obscure concepts of risk. Well, I think it also helps to take risk right down to your individual level. How do you feel about risk? What does risk mean to you as an investor? And some of that comes right down to, you know, what makes you afraid, and what do you need your portfolio to do? So this is something that I think it does make sense to spend time speaking with your advisor about. Right? What are the dangers that we're trying to offset? So risk can, here's 5 very common views on risk. Risk can mean losing wealth, right? Losing principal, permanent loss of capital, not a good thing. Risk can also mean underperforming some benchmark, the S&P 500. To others, risk is the volatility that we've seen. up and down. That's a bad thing. That's what risk is. Still others, risk can be not meeting goals or missing out on potential returns. So I think it's important to frame risk around these concepts. And quite honestly, I believe some areas of this chart are not worth focusing a lot of attention on. I think losing wealth is a real concern that we should all focus on. I think that's a real risk that we should address and always be aware of. Not meeting goals is also another risk, I think, of investing. Right? I'm not going to be able to retire in time, or I'm not going to be able to fund some other events or life occurrences that I'm trying to fund, whether it be college or retirement home, whatever it is. So those are two real risks that I think we can make meaningful headway with. And some of the tools that I'm going to speak about and ways that we approach risk will focus on those two. Market volatility is also, like I said, it's basically a function of an investing return, but there are things that we can do to reduce the ups and downs. Underperforming the market and missing out on potential returns, these are very common issues, but from my point of view, they're probably the least important and least relevant to your individual situation. Underperforming a hypothetical benchmark, how does that impact when you can retire? How does that impact whether or not you can pay for your kids' college education? It doesn't really. So those are goals that might upset us, but I think they are less concerns than some of the other higher level risk management concepts. So we tend to take an approach that says, accept as much risk as you need to achieve your financial goals, but not anymore. We also have a philosophy that pursuing return is certainly a worthwhile goal, but eliminating unnecessary risk is perhaps even more important as a goal. Are you being compensated for the risk you're taking? And when we see, particularly with newer clients that come to us with portfolios, we see a lot of that, where they've acquired securities over time, and those securities, some have gone up, some have gone down, but they've created risk that they may not even be aware of. One common risk today, I think, might be in dividend-paying stocks. I happen to think dividend-paying stocks play an important role in portfolios. They're performing well, but a portfolio that's only invested in dividend-paying stocks may be subject to more risk than you think. A lot of those stocks are going to react the same way, and constructing a portfolio that has some stocks that are exposed to that dividend factor, but other stocks that are more influenced by other factors such as growth and opportunity for upside might be a better way of balancing risk and reward. Here's just another quick chart that talks about the ups and downs in the markets and how over time, if you were invested from 95 to date, you did very well, but within that period of time, there were lots of times when you probably went from being real excited and euphoric to other times when you were panic-stricken. And there's a line that shows if we were able to smooth everything out, what it would look like. But unfortunately, that's not the case. So what do we do to manage volatility? Well, I still believe bonds are perhaps the best diversifier for equity risk. This is a slide right here that looks specifically at monthly periods of time where stocks were down. So during these periods of time when stocks, these months when stocks are struggling, how did various asset classes do? And what this shows is that U.S. Treasuries have provided that downside protection when investors need it most. And other U.S. bonds, including munis, corporates, and foreign bonds, have also partially offset times when stocks are down. So high quality bonds remain a very effective diversifier, and it all comes down to negative correlation. I know I'm going back to a technical jargon, but essentially what that means is that stocks don't necessarily move in sync with bonds, and this year has been a great example of that. We started the year out really poor. Stocks sold off quite a bit, 10, 11, 12%. Stock market was down through the first 60 days, 45 days in that range through mid-February. But treasuries were up quite a bit. So they offset a lot of that downside protection. Now, the problem is bonds don't yield a lot today, and bonds are getting a horrible rap in the industry today. Bonds are risky is the way the mantra goes. But I would say, one, I think that risk is overstated in the environment today, and two, I would also highlight this slide and reinforce the fact that not all bonds are the same. Not all bonds act the same in the same situation. So this slide right here looks at specific instances when 10-year yields rose 1% or more. And that's what everyone's afraid of right now. So when that happened, long-term treasury bonds got hurt. Interest rates went up, long-term bonds prices went down. But not every area of the bond market was affected the same way. As we show here, treasuries are in the red, but short-term corporates, high-yield, junk bonds, floating rate bonds, convertible bonds, and the S&P 500, I know it's not a bond, but it's here for comparison, those all were able to produce positive returns even in a rising interest rate environment. So yes, be aware of the risks that bonds present, but don't run away from that risk. That duration can benefit you as an investor, and again, not all bonds are the same. Don't paint them all in the same picture. So another thing that I think is very important in terms of managing risk is time horizon and time frame. So this slide shows the returns of stocks and bonds, and also a combination of 50% stocks, 50% bonds. And what you can see is over a one-year time period, in every category, there's a wide range of returns. There's down years, there's up years. Same thing with bonds, although not to the same extent, and the balanced account is somewhere in between, which kind of makes sense. So if your investing time horizon is just 1 year, a portfolio of 100% stocks, or even 50-50 stocks might not, 50-50 stocks to bonds might not be the right portfolio for you because your time horizon is short. But if you extend out to 5 years or 10 years, the longer you go out, the less risky it appears stocks are, the less risky bonds are. And since this study was conducted, which goes back to 1926, there's been no 5-year period of time when a 50-50 stock to bond portfolio has lost money. So use that time diversification to your advantage. Resist the urge to look at your stocks every night, every week, or even every month. The more frequent you look at the stocks, the more likely you are to be disappointed. The more that you are able to trust and have faith that stocks and the economy will do well over the long term, the more likely it is that you'll be able to stick to your strategy and get the results that you need. So diversification, we've sort of been talking about it indirectly so far. It's another powerful tool. So stock to bond diversification is also diversification within stocks. What's interesting about the science behind portfolio management is that if you are able to combine, so on this hypothetical slide here, I've got 3 different securities. Every one of them started low and finished high, which is a good thing. But they all moved a little bit differently. Up, down, up, down, up, down. So if you owned any one of these stocks individually, you had quite a rocky road. If you owned all 3, it smoothed out the bumps quite a bit. You still received that same return. It didn't hurt your expected returns. But what it did do was smooth out the risk and volatility. So that's a powerful component that we definitely focus on in our portfolio management strategy. Another real risk that I see all the time, and again, I don't know if clients think about it from a risk point of view, but that has to do with the risk of over-investing in cash, especially today. Cash is yielding close to zero right now. But yet there's many clients who are still on the sideline, either with all of their portfolio or a significant portion of their portfolio. And their reasoning goes something like, well, the economy is not growing fast, or there's too much volatility and it just feels right to stay on the sidelines for a while. The problem is cash returns are near all-time lows. If you account for inflation on top of or subtracting from the returns that you receive from cash, you're actually losing purchasing power. And unfortunately, low yields are likely to persist into the near future, certainly. And here's a slide right here that shows where we are, the state of yields right now. So I caution you against using cash too much as a place to hide indefinitely. Cash is a tool. Cash is an asset. It doesn't lose value in today's money, but it does lose purchasing power. So don't overinvest in cash is the point. That is a risk. So here's where I spend a lot of my time, and it has to do with portfolio construction. And this also can be an industry type of concept that maybe there's some confusion around what does that mean, portfolio construction. Well, basically the bottom of this chart right here is where I think most investors spend most of their time. It's where the media spends most of its time. Identify or tell me the investments with the best return potential. That's what I want to own. Give me the stocks with the best return potential, and that's my portfolio right there. And certainly that helps if you know what those stocks are. Unfortunately, that's probably the least reliable way to construct a portfolio. It's difficult to predict with any certainty which specific securities are going to outperform. I mean, there's a lot of different strategies, and we certainly utilize many to try to identify that. But particularly in the short term, that's why it's at the bottom of this list. That's an area where we have the least amount of impact. We can impact your portfolios far more by focusing on some other areas. So let's start from the top and not the bottom. So harvest many return sources. Go back to that diversification screen. Don't just pick one stock when you think there's 3 or 4 or 6 or 20 that all have positive expected returns. Combine them all in a portfolio and put the odds in your favor. And don't just focus on one asset class like U.S. large cap. Own some small caps, own some international, own some bonds, own some riskier bonds, own some foreign bonds. Combine all these different return sources into a portfolio. It does make a difference. Allocate your risk. Right? Risk is not just the number, and it's not just, well, my portfolio went down 5%. I like to look at risk from a couple different components. So there's general stock market or equity risk. It's probably what we're most comfortable understanding. But then there's interest rate risk. Again, I mentioned how bonds are getting a bad rap because of this interest rate risk. There's inflation risk. If you're retired and you have certain expenses, if inflation goes from 1 to 2 to 3 to 5%, that's a real risk to your purchasing power that you should be aware of and try to invest to offset. So those are three main areas about risk that I think it's important. And one last one is credit risk on the bond side. So four different types of risk, and it's not a bad thing to have some exposure or to accept some risk in each of those 4 areas because they tend to complement each other. Seek low correlations. So you want stocks and bonds I mentioned that are not very well correlated so that they don't move together. Limit risk concentrations. This is a pretty simple concept. I think it's pretty well understood, but I still see a lot of portfolios that have way too much exposure to one or two stocks. Target appropriate volatility levels. This is something that we actually have some pretty good tools internally that we could work with our clients on to identify what that appropriate volatility level is for you. So if you haven't done it already and you want to speak with us about a risk assessment, now's a great time for that. Tactical adjustments. So that's basically, there are some times when it does make sense to rebalance the portfolio or to make some adjustments out of securities that we think are priced to underperform into securities that we have a more attractive outlook for. And then just general things that we all can control, like keeping trading costs low, paying fair fees, managing taxes. These are things that we do have some control over, and we should focus on the whole top of this. Don't ignore looking for securities with the highest expected returns, but acknowledge the fact that that's the hardest way to impact returns in the short term. So let's talk a little bit about some macro risks. There is some concern out there today. This is real. This is happening, that, you know, the global economy is going into a recession. Other parts of the world are already in recession, and it's not going to get any better. Certainly that's a risk. I don't think that is a likely occurrence in the U.S. market. The fact of the matter is, bear markets don't just happen. They're triggered by external factors, and those factors tend to be recession, aggressive rate hikes, or spikes in energy and oil prices. Those are three real factors that have led to bear markets in stocks. And if you look at the environment today, it's hard to see any of those three as an immediate concern in the U.S. economy. And so therefore, we don't think we're at the start of a bear market, just a period of volatility and muted returns. So the fact that the bull market has been going on for a long period of time is not in itself a reason to sell out of stocks, but it is a good reason to rebalance, to look at the risk that you're exposed in your portfolio, and we can help you with that. So you're a client of ours, you have a plan, we have an allocation for you. I discussed some of the ways that we try to manage volatility. How does the day-to-day monitoring of your portfolio go? What does it look like? Well, we have a couple different levels, and we have some very sophisticated tools that we use to monitor every one of our accounts. And there's four main categories that we try to look on. Like, one is strategic rebalancing. So if there's a point in time when we want to reduce or add to a certain asset class, we can do that. If you have a portion of your portfolio that has done very well, and now it represents more risk than we want in your portfolio, these tools will alert us that, hey, we should look at this portfolio a little closer and perhaps take some profits and reallocate that to other assets, so we keep your risk level in line with where it needs to be. Tax loss harvesting. With this volatility, there is opportunity for harvesting or recognizing losses. And on the surface, that's, you know, not the most exciting thing to talk about. I took some losses, but the fact of the matter is, systematically taking some losses where it makes sense can be useful to offset future gains and reduce the tax bill, which improves after-tax returns. Risk monitoring, I kind of highlighted that. We want to always be aware, and we have some systems in place to help us identify when a certain area of the portfolio is not acting like it should or represents more risk than we're comfortable with and requires further action. And then cash management is dealing with your liquidity needs. Many of our clients have needs on a short-term basis. Every month there's a certain dollar amount they want to withdraw from the portfolio, or every quarter or every year. We have plenty of systems in place to monitor that and to generate that cash if needed and when needed. So it's always there for you. So I'm going to summarize this call up a little bit on a few main concepts that we that we talked about. And I understand it was pretty general, but that was by design. Risk management and volatility does not have to be a overwhelming or overly sophisticated system. I think some general concepts can help us all go a long way in terms of achieving our goals. So a couple reminders. One, no one can reliably forecast the market's direction, particularly in the short term. That's not what we're trying to do. We're not trying to make forecasts. When markets become volatile, we all have a tendency to get concerned, and that can lead us to react and deviate from our long-term plans. Ultimately, that hurts our returns. Remember the slide I showed before about the average investor returns lagging. Having a financial advisor like Krasny can help walk you through this whole process. Make sure that your plan makes sense. And some simple areas that I think do warrant attention are, creating that investment plan to fit your goals and risk tolerance. Structuring your portfolio around your needs. And, we all have different needs, but a lot of them come down to three main areas. You need growth, you need income, or you need to preserve your wealth. Some of us need to do all three of those things. Make sure that the strategy you're invested in is one that can achieve those three main concerns of yours, and make sure that it's a strategy that you can stick with in good times and bad. Don't be pushed to react, to change course just because the market decided to sell off 10%. That doesn't usually result in better returns. So diversify, reduce turnover, minimize taxes. We spoke about all these things. So Rob, do you have any questions?
Yeah, we've got a couple questions from some clients, and before I go into those real quickly, I just want to mention that Steve discussed the importance of managing risk and how important it is for you as the client to understand how much risk is embedded in your portfolio. And I know many of you have already gone through this process, but I think there's many of you out there that have not gone through this process yet, and it's a process that we call Riskalyze. And if you haven't gone through it yet, I really encourage you to do so, because what it does is it can measure the level of risk that's in your portfolio. Not only the portfolio that we're managing, but also other portfolios you may have, your 401k, an annuity, money that you're managing on your own, etc. And it also measures the level of risk tolerance that is suited for you. And once you know that your wealth is allocated at a risk level that you're comfortable with, I think it takes a lot of the anxiety away from investing in volatile times, and allows you to stay on a course that'll get you where you need to be in the long run. So I just encourage you to reach out to your client relationship manager if you haven't gone through Riskalyze yet, and go through that process. So Steve, one of the questions we got was, what changes have you or will you make to the investment strategy to not only protect but also take advantage of what occurred after the Brexit vote?
Yeah, that's a great question, and it's certainly a question we've been receiving this week, and it can be applied to any period of time of volatility. So we actually try not to trade into volatility after volatility has occurred. Our preference is to rebalance quarterly, and that is based on a lot of studies that we've participated in and done ourselves that show more active trading than that doesn't actually add to returns. What it tends to do is add to brokerage commissions, fees, and taxes, and those are things that are a drain on return, not an add on return. So a more active trading strategy, sure, it could increase the number of winning trades. That's a good thing. But what we found is it also would increase the number of losing trades, which is not a good thing. And those two tend to offset each other. So that short-term trading pattern is something that we try to avoid. We actually try to slow down the process a little bit and make sure that when we do trade, we do it with conviction and we do it with discipline. And for the most part, every 3 months is a reasonable period of time to do that. There are going to be opportunities to trade more frequently than that, and a lot of that has to do with the significance of the decline or increase. And quite honestly, a 10% move is not enough to move your portfolio allocations enough to create concern and create a need for us to trade more frequently than that. We're really not trying to capture the next 3 or 5% move. Our time frame is longer than that. Now, a 20% move in markets, that would be something that would cause us to look into it a little bit further and adjust portfolios. But what that means in real terms, so if you have 60% of your portfolio in stocks, if that portion of your portfolio grew to 65% of your portfolio or even 70% of your portfolio, we really don't feel the need to go in there and trade. If it pushes up above 70%, now you're at 72% stocks. The stocks have done real well. That's at a level where we've decided, you know, now you have a lot more risk than we originally intended. Let's pull that back. Same thing on the downside. A pullback of 5% from 60 to 55% equity in your portfolio, not really something that we feel the need to aggressively trade. If it drifts down below 50%, yeah, that's a time when we think maybe we're not accepting enough risk and maybe there's opportunity there to reallocate to the accounts. So I hope that answered the question.
All right. Another question we have is, you know, why we don't use, you know, like stop loss orders or, you know, look at, you know, resistance or support levels like moving averages, you know, to maybe help protect against declines in stocks or in the market.
Another great question, a common question, and I actually do follow technicals. I do believe in technicals. I think they have a place in portfolios, and specifically about moving averages. So the idea that, hey, when stocks are above the 200-day moving average, you want to own them. When they're below the 200-day moving average, you want to sell them. Go to cash or go to bonds. That's a very common strategy that's out there, and it's been, you know, pretty well followed, and it's discussed all the time in the media. But if you look closer at what that actually does to your portfolio, I actually think a strategy like that is harder to follow than our strategy. So let's think about what that does. By using a moving average like that, going back into 2008, it certainly helped you, right? Stocks started to roll over, dropped below a moving average. I went to cash. I missed out on some of the worst part of the downside in 2008, so that's a good thing. However, those types of declines don't happen often. They're very rare. Maybe they happen once or twice every 10 years. So the other 8 out of 10 years, let's say, a moving average is going to lag a more traditional balanced approach like we take. So, and the reason that is because markets, most of the time, they're not ripping to the upside and they're not crashing to the downside. Most of the time they're in some type of a trading range like we've been in the last 2 years. And during those periods of time, stop losses and moving average systems create a lot of trading activity and a lot of small losses to your portfolio, which eat away at your return. So if you were in a 200-day moving average trading system going back past 2008, even with 2008 where you didn't lose as much as the broader markets, you've still lagged a traditional 60-40 mix of stocks and bonds, buy and hold, don't trade it at all. You've lagged by quite a wide margin. And the number of winning trades that you've had with that trading system has been far below 50%. So the question I have is it better, and can you stick with a trading strategy with where maybe 3 out of every 4 years you're lagging? Could you stick with that strategy? And I think the answer for most people is no, and it's one of the reasons we have not chosen to use that as a defining component of our risk management system. I want to let you all know that we do look at moving averages. We use them in some of our factor analysis that Eugene uses in picking stocks and sectors, but it's one of many factors that we look at. And I would caution you against devoting too much attention to a strategy that encourages, you know, moving average systems or stop losses. So I think that's all for tonight. We've gone a little longer than we normally do. I appreciate all your time. Thank you for joining us on the call. Rob, thanks for hosting. Great job. And of course, if anyone has any questions that you want to discuss about the general concepts or specific questions on your portfolio, please give us a call. My email is here on the screen. You can email me anytime or call the office, and I'll be happy to speak with you as well. Thank you, everybody, and have a great 4th of July weekend.